All right. Okay, so let's just start with the US labor. Let's begin with the most recent NFP. Let me go into Finlogix.com. That is my go-to when I want to have a look at the economic calendar. For those who don't know, Finlogix is a sister company from ACY Securities, and it's a provider of economic calendar, providing charting tools, etc. I've sent the link into the comments, so you guys can have a look into as well. And if you have any questions, you can just ask me. For those who don't know as well, every Wednesday we do trade together using the Finlogix sentiment tool. Okay, so if that feels interesting to you, come back next Wednesday and let's have a chat. So let's go into economic calendar. Very easy. You can just come into tools and an economic calendar, and I'll just want the United States. So click on this little globe and then just United States, and then I go into this month, and then I go into NFP, but wait a minute. Okay, it's already NFP Friday. There you go, here. So you can see that the United States non-farm payroll May, unemployment rate, and average hourly earnings. Okay, so these three here are the ones. This is what I mean, Beno. This is what I mean when I'm saying NFP. Okay, I don't only mean the non-farm payroll. I mean the whole thing. Okay, so right here, those three. So the non-farm payroll report, at first glance, the data seems to be very solid. 139,000, 9,000 above, a little bit below the previous, but still higher than the consensus. Jobs added in May, average hourly earning, above the expected as well, was expected to be 3.7. It didn't change pretty much from previous, but again, the hourly earnings is up. It's not up, technically it's not up, okay, it's just up from the consensus, but technically if you look, it's the exactly same thing than the previous. So there's no sense for me to say it's higher than the last month. It's like, no, it's not. But anyways, is this a strong labor market? Not so fast, okay? Because behind the headlines, there's a much more fragile reality, all right? The prior 2 months, they were revised downward by nearly 100,000 jobs. And that's material revision, that's household employment, which it reflects on actual people working, not just payroll positions. It fell by 696,000. So the unemployment rate rose to 4.2. Didn't change to 4.2. But in my understanding, that is higher. It's the highest over 2 years, in my opinion. Okay, so more striking is the growing gap between the establishment survey and the household survey. Because if you look at one, it paints a picture of expansion, and then when we look at the other, it shows a picture of contraction. So this is not a statistical nuance, it's a signal of growing unreliability in the most watched jobs number in the whole globe. Because do you have a look at the NFP from Canada? No. Do you have a look at NFP from Europe? No. Do you have a look from NFP from Australia? No. But all of them, they have it. Okay, they have it. So they do have. But the thing is, no one cares because everyone watches the US. So, it's basically an unreliability in its own. They're doing this in the most watched jobs number globally. And the markets still trade off these numbers, of course, because it's money to be made. So that's it. But, traders, desks, and institutions, they're very, very skeptical, because what used to be a reliable barometer for economic momentum is now often traded as like a political headline. Like Every time, take it like for example, like yesterday, as CPI came in below expected. What did Trump do? Oh, tweet. See, on my job, I'm doing a good job. Inflation is down. The Fed should cut. This is not about economics anymore. This is about political. Okay, we're getting political, and that's exactly what I mean when I say the U.S. labor market paradox: reliable signal or political theater. For me, it's a political theater. Okay. The algorithms, however, as I say, they still react to the first print, of course, and that creates a volatility that is often reversed days or a few days or a few weeks later. Once the revision comes through. So I thought it would be quite good to mention that, because if we look at the NFP. What do you guys expect from US economy, from US dollar? To be quite strong, right? Well, let me just go into trading view because unfortunately we don't have US dollar index for those who asked. We don't provide. But let's just go here into the US dollar index. Sorry, guys, my voice is a bit funny because I'm still a bit sick. I'm drinking a lot of water, try to minimize that, but it's just sometimes in the day it gets very, very bad. Just a second, let me drink some water, guys. Okay, cool. Um, as I was saying, if we look to the US dollar index, what just happened? Wasn't the NFP much stronger? I mean, come on. What is this? It's just going below, below the 100. If we look back, that's a 1 hour chart, okay? Lots of people were calling me crazy because, oh man, come on, US dollar will never break. It's gonna never go down. Well, it's here. Surprise, surprise. Okay, so that's what I'm telling you. This is not about economic data anymore. It's about political theater. And be careful, because that's getting very bad in a sense. But we're gonna discuss this. We're gonna discuss this in the coming days. Now, next topic: yields surge, the gold falters, and the domino effect of the data-driven volatility. On the wake of the hot NFP release we had, um, I will consider this a hot than expected. I mean, as I say, the NFP for me is not only the non-farm payroll, because a lot of people feels like, yeah, cool, the NFP came in higher, but what does that mean? Did the jobs came in higher? Did the unemployment rate came in higher? Did the average hourly earnings came in higher? Because if the unemployment rate came in higher, that's not good, right? So we have to analyze the context of it, a context of data, and that's exactly what I always, it's exactly what I've always been saying for everyone. NFP it's an aggregate of three data: unemployment rate, non-farm payroll, average hourly earnings. Okay, so I'm going to consider this a higher than expected, a hot NFP release. The bond market quite had a jump. Okay, so if we have a look into bond market, maybe 10 years. Just zoom in here. Oh wow, that's not what I want. Just a second, guys. Let me reload that. Okay, so let's go into 10 years. So if you have a look just here, we can see right on Friday, okay, at the time of the release, we had quite a strong movement for the yields, okay, and that's the 10 years. So that's the somewhat of a medium to long term yield. And that is quite interesting because the 10-year Treasury yield, it surged back to 4.5%, as we can see. But, just afterwards, it dropped into the CPI. But forget about the CPI. We're going to talk about that later on. But just about the NFP here, it sort of stabilized in that area into the 450. And that's, reestablishing a critical resistance zone that had been broken in May. Um, but the move higher in yields wasn't just a mechanical repricing, it was an aggressive unwinding of rate cut expectations. Because when the NFP got released, CME Fed Watch 2 quickly repriced the rates cut for longer for higher. Okay. And I've been talking about that into the YouTube videos for quite a while. For those who don't know, we do have a YouTube channel. It's called ACY Securities, and we post daily videos and daily content in there. Okay, so it's very helpful for you that are starting out, for you that are maybe even trading for a while already. It's not even profitable. Want to have a look into what's going on into the fundamentals? Definitely hit it up. The channel, it's pretty good. So, as I say, it was an aggressive expectation of the rate cut. Okay. And the market had previously priced in 3 rate cuts for 2025. And now we're looking at 1 at best. Okay. 2 at best, 1 at worst case scenarios. So 1 cut has been gone already. That is not being expected anymore. And this shift in interest rates expectation, they had an immediate consequence. If we look at gold, for instance, right here, right, Thursday, Friday, there you go. So this jump here. So gold, which had been trading above the 3,000 sort of $360, it sharply reversed that and it dropped pretty much over $60. Okay, so from here, from the release to here, that was 60, yeah, pretty much $63, $65. So the reason is simple, rising real yields. And then when real yields rise, the opportunity cost of holding gold increases. And suddenly, what looked like a confirmed breakout became a failed one. But of course, afterwards, it just reversed back up. And we're going to talk about that. But this wasn't an isolate event because if we look across the risk asset class, correlations began to shift. So gold, bonds, tech stocks all moved in tandem with yield expectations, reminding us that everything rally is increasingly reliant on the idea of loser policy. When the idea gets challenged, everything sort of reprices much fast. Sorry, guys. And so why did the federal hold the rates steady again? Well, the key reason is uncertainty, right? Not just about inflation or growth, but especially about external shocks, including, of course, the US tariffs imposed under the President Trump administration. And the way these shocks are filtering into core inflation and business expectations, it's been much more, I would say, it's denificating much more the economy than what is bringing money to the economy, than what Trump sort of told that would be the scenario. Okay. Paul already emphasized that this during the press conference. The Fed is watching carefully how tariffs are impacting price stability and demand. No, sorry, guys. Let me just drink a little bit more water here. All right, I'm back. So, yeah. Anyways, as we're saying, I guess if we look into a perspective, gold has pretty much everything to continue to rally. Uncertainty, higher yields. If yields continue to go higher, as they say, it wouldn't be the best for gold. But if yields continue to drop, we may have a higher gold. And we're talking even about 3,600. We can probably talk about 3,600. It's just going to depend on how I would say, more likely about Trump, how Trump would react into tariffs, and how he would make relationship with other countries. Okay, but yeah. Anyways, so let me try to break this down. So the monetary policy is into a crossroad. Okay, after three rate cuts in 2024, largely aimed at cushioning the slowdown triggered by the tighter credit conditions and the weaker global growth, the Fed tried to shift into a more neutral stance in 2025. Right now the Fed is walking into a, how can I say, into a very fine line. Okay. As of On the other hand, inflation remains above the 2% target, because we did have inflation yesterday, but still above 2% target. The most recent readings, it's showing that the PC inflation trading near 2.7. It's slightly declined from late 2025, but still elevated enough to justify caution. On the other hand, the signs of economic softening, particularly in manufacturing, housing, and consumer confidence. But, anyways, okay, so that was that's what I have to say about, and that what I've been noticing. Okay, as well. Cool. So, as I say, it's not an isolated case. It happened quite. If everything rally is increasingly reliant on the other idea that policy, loser policy. Now, moving on to the US dollar. So we have a US dollar resurgence and the FX crossfire. Well, currency market, right? Let me close this one. Currency market has been quite interesting the last couple times. So, very reactive. Okay, so the dollar surged across the board, following the NFP and the repricing of the Fed path. US dollar, Japanese yen, like, look at that. All right, US dollar, Japanese yen, as I've mentioned, was a good trade. We took yesterday, I think. I'm not too sure. I can't remember this week or last week. It broke above the 145, couldn't sustain itself there. CPI came in, boom. A lot of money moving to Japanese yen. And then it's reviving talk of yield curve control in Japan and the potential interversion risk from the BOJ. So Bank of Japan, yeah, there's lots to do. Euro dollar is back above the 1.15, where I've mentioned before that could probably happen. Still not on the all-time highs for this year, that is 1.15742, but it's very close, and shouldn't be too long for going up. The spread between German and US yields, they widen again, so that sort of reverse the gains from the the gains from the US dollar. So basically, euro gets the money from the table and continues to go up and higher. Okay. Aussie and New Zealand, two high beta currency, risk, very, very risk sensitive currencies, came under pressure as well, partially due to deteriorating risk appetite and partially because the respective central banks remain on hold while the Fed holds the line. So these currencies serve as proxies for global growth, China sentiment, and commodity exposure, of course. And soon as the trifecta weakened, of course, the effects of those currencies, the Aussie, the New Zealand, weakened as well. And we have a trade that I think we had a trade on the Aussie dollar yesterday that was short. Was it Aussie dollar? Yeah, I think it was Aussie dollar. So quite a good position as well. So very interesting to see. Now, my takeaway is that FX markets are now acting as a real-time proxies for the macro sentiment. Okay? The yield differentials, the risk appetite, the trade tensions, they're all getting priced in more aggressively. Soon as the things start to bubble, FX is already priced in. So and often much faster, than equity or bond markets. So in my opinion, it's been very tough in the last couple weeks to know what can happen, and it's a fast but it's slow market as well. It's a fast in the sense of when it happens quick, and it's a slow that when it slowly gets in, slowly happens, and then when there is a catalyst, boom, market moves into direction that should be going. So I would say all of the for pretty much everyone here, if you have a strategy, stick to your strategy, manage your risk, because there's quite big waves coming into the ocean from the ocean in the coming weeks, I would say. Cool. Now, I think it's our last topic is China. I've left this one um, um, for last, but I have to talk about the CPI as well. We're going to be talking about that in a second. So the China silent realignment, it's a rare earths and trade power. Okay, so where should I start? So much things to talk about then. But US markets, they are focusing on the Fed. China is pursuing a broader structural shift. Trade data from May showed a 30% year-over-year drop in exports to the United States, of course. But overall, Chinese exports are rising, just redirected. Okay. I think Trump had an idea that China without US can't they cannot leave. They're gonna die in a sense. When I'm gonna be honest, that's not what's gonna happen. Okay. I think most likely US I think US without China dies quicker than China without US. Because everyone wants to be friendly with China. Cheap labor, very nice people, easy way to connect to the country. Strong army can protect you. Of course, US can as well, but US is much tougher to do business than China. Okay, so I reckon going into China, all the countries going to China is easier for them to get business done than going to the US. But it's just my opinion. The the Beijing is doubling down on emerging markets and intra-Asia trade, reducing dependence on Western demand. But the real storylines lies beneath the surface, that's the rare earths. China controls over 80% of global rare earth supply and dominates the entire value chain from mining to processing. These minerals are essential for electronics, EVs, defense systems, clean energy technologies. And this isn't just economic leverage, it's a geopolitical capital. And Beijing knows it. While the US imposes tariffs, China tightens exports quotes on the elements it knows the West can't easily replace because they have 80% of the supply. Okay, so this raises long-term inflation pressure and forces the Western to supply chain to rethink about the dependency. And that's exactly what I say. China has everything to be on their own, as of US can't. In short, US needs China, not China needs US. And I think it was like last week or maybe a week and a half ago, Trump posted on his X, very tough guy to do business with, but we will continue to negotiate. Now the cards are not on Trump's hands anymore. It's on China's hand. And they know how to play with those cards. Okay. So very interesting. Very interesting. Anyways, let's talk about the US CPI. So let's put this week. There you go. Over here. Okay, so United States core inflation rate over month, inflation rate, and then core inflation rate. Wait a minute. Okay. So year over year, month over month, and then month over month and year. Okay, now it makes sense. So let me just take these ones and be like that, easier. So inflation, core inflation, core inflation. All right, so we had the release from the CPI yesterday for US. We had a quite interesting release, okay? We had a 2.4. Everything was below expected, but pretty much not that big change from what was the previous one. Okay, so if we look at inflation rate year over year for May, it was 2.4% from the forecast 2.5. Previous was 2.3. Core inflation rate 0.1 from forecast 0.3 and previous 0.2. Rate month over month 0.1 from forecast 0.2 from previous 0.2. So it wasn't expecting changes, came in to be below. That was pretty good. Core inflation rate year over year 2.8 actual, 2.9 forecast, 2.8 previous. So no changes. Okay. So very interesting. Very interesting to see. Guys, just 1 second. Sorry, guys. Just came back. So what does that has to say for me? Well, it's quite interesting because it doesn't make any sense, right? And as I say, the data is not making sense. Because when you look at the NFP, it's higher than expected. So therefore, should we have more people buying products? If there is more people buying products, people are generating inflation. So how does this inflation come below? Doesn't make any sense. Okay, and that's why I'm telling you, it's a political theater. It's more than ever been a political theater. So there's literally no sense. Maybe US is lying into a data point of view, and we really are with hands tied. Where to go, we don't know. Okay. Most likely, of course, the market will trade the print. When I mean that is the market will trade the release. It doesn't matter what the release is. It's good, bad, whatever. The market will trade it. But what I mean is, if you want to be into a macro perspective, the next couple of weeks will be very interesting to see. And I know I always say that the next couple of weeks, but because it is the next couple of weeks, because we all had the release from last week, the NFP, this week the CPI, next couple of weeks would be very interesting to see what can probably happen with that. Okay, so I guess that the CPI will continue to be somewhat of a weaker point of view, and we're going to be having lower numbers, but the Fed will hold the rate higher for longer. Okay, there's 2 cuts predicted for this year. So as I say, I'm expecting only 2 more to go. So it will be very interesting to see how this will happen. All right, guys, thank you so much for today. I hope you guys could understand what's going on in the market. You guys could, sort of get what's going on. And if you have any questions, please just send me over and I will be happy to answer them. I'm going to give a minute for everyone to send me the questions through. No questions? Okay. Well, hope to see you guys back on Tuesday then. Thanks so much for another week. And yeah, stay tuned. Tomorrow we'll be on tomorrow we'll be on the TV, most likely talking about that. And let's see what they're going to ask me. Thank you so much. Have a great weekend ahead, and I'll chat to you next week. Cheers, guys. Bye-bye.